The government is preparing something extraordinary, a quiet plan to reprice gold and even buy Bitcoin. It might sound unbelievable, but this isn't rumor. It's a coordinated move unfolding inside Washington that could completely rewrite how money works, not in theory, but in practice. Most people expect the next monetary reset to come from outside, from the BRICS nations or a new digital dollar. But what if the real reset is being engineered from within the U.S. Treasury itself, a plan that begins with gold, ends with Bitcoin, and changes everything about debt, inflation, and how assets are valued? Those who understand it early won't just protect their wealth, they'll multiply it. Let's break down what's happening and what it means for you. It all started quietly, buried inside a boring tax proposal that most people ignored. Hidden in the language was a new 5% tax on remittances, money sent abroad by people living in the U.S. In plain English, it means anyone wiring dollars out of the country now pays a toll. At the same time, lawmakers floated a section known as 899, a retaliatory tax designed to punish countries that impose digital taxes on U.S. firms. It didn't pass, but the message was loud and clear. America is willing to tax global money flows to protect its financial dominance. On the surface, this looks like a normal trade or tax policy, but just beneath it, a much bigger shift is taking shape. While all this is happening, the BRICS nations, Brazil, Russia, India, China, and South Africa, are quietly cutting the dollar out of their trade. They're using their own currencies, yuan, rubles, rupees, reals, to buy and sell real goods like energy and raw materials. In other words, they're monetizing their supply chains, but the U.S. can't do that easily. It doesn't export as many tangible goods anymore. So instead, it's monetizing its payment chains, the financial networks the world uses to move money. By taxing remittances, digital transfers, and dollar flows, the U.S. is turning the dollar system itself into a profit center. This isn't about defending the dollar anymore, and it's about charging rent to use it. That's what some analysts call the Great Squeeze. Each step, from tariffs to taxes, tightens control over capital, forcing dollars to stay inside the system while making foreign users pay for access. But behind this public plan lies something deeper, a quiet seven-step strategy designed to reset the entire system, beginning with gold and ending with Bitcoin. Step 1. Scare gold back onshore. In 2025, the White House introduced a universal 10% tariff on imports. Officially, it was about trade balance. In reality, it created uncertainty across global supply chains, the kind that makes nations and investors pull their assets home. History gives us a clue here. In 1933, President Roosevelt ordered all Americans to surrender their gold to the government. A year later, he revalued gold from $20 to $35 an ounce, instantly devaluing the dollar. When trade rules and debt systems change at the same time, gold always comes home first. Germany did it too, repatriating hundreds of tons of gold from New York to Frankfurt between 2013 and 2017 for accessibility in a crisis. Step 2. Target foreign holders of U.S. dollars. Section 899 may have been struck down, but its purpose was clear, to signal that the U.S. can weaponize taxation against anyone holding dollar-linked assets. That message only needs to be sent once. After that, global capital starts to move on its own, exactly where Washington wants it to go. This is a controlled demolition, not a collapse. Step 3, tighten the digital layer. Under U.S. law, stablecoin issuers like USDC are not allowed to pay interest to holders. That restriction pushes yield-seeking liquidity offshore, into places like El Salvador, where Tether operates freely. Today, Tether controls more than half of the global stablecoin market, while U.S.-based issuers remain under strict control. The result? A smaller, more controllable circle of digital dollars inside the U.S. and a massive pool of offshore liquidity outside of it, both ultimately dependent on American rules. When you control the rails of payment, you control the flow of capital. And when you control the flow of capital, you control the future of money. Step 4. Let gold quietly climb. By late 2025, gold had surged past $4,000 an ounce, breaking record after record. Central banks were buying at historic rates, and the Federal Reserve was cutting interest rates again. A weaker dollar, lower rates, and global demand combined to push gold higher, exactly as policymakers allowed it to happen. Step 5. Reprice the gold and unlock hidden value. The U.S. holds over 8,000 tons of gold, yet it's still valued on the books at only $42 per ounce, a price set in 1973. If that gold were valued at current market prices, it would be worth about $1 trillion instead of just $11 billion. By simply updating its valuation, the Treasury could inject roughly $1 trillion into its main account without printing or borrowing a cent. That's exactly what Roosevelt did in 1934, and the extra value was used to stabilize the dollar and manage reserves. It worked once, it can work again. Step 6. Build a strategic Bitcoin reserve. In 2025, a new executive order created a strategic crypto reserve, seeded with Bitcoin already held by the U.S. government from past seizures. At the same time, officials began referring to Bitcoin as a strategic monetary asset. The U.S. already controls nearly 200,000 Bitcoin from previous cases, worth billions of dollars. Buying a little more each month would barely be noticed by the market. If the Treasury revalued gold and suddenly had $1 trillion of new liquidity, using a small slice of that to accumulate Bitcoin would make perfect sense. Bitcoin becomes the digital hedge for the new financial era, just as gold was for the old one. Step 7. Let the hard assets reprice the system. Once gold and Bitcoin are on the balance sheet, policy can ease. Rates drop, liquidity returns, and inflation quietly does the heavy lifting, revaluing assets while devaluing debt. That's how every major debt system resets, not through austerity, but through inflation and asset repricing. Gold rises, Bitcoin rallies, and the books get cleaned. Zoom out and it all fits together. Tariffs, taxes, gold revaluation, Bitcoin accumulation, all parts of one coordinated reset. The goal isn't to destroy the dollar system, it's to rebuild it, this time backed by hard, decentralized assets. Treasury officials have openly said the U.S. must secure first-mover advantage in the next financial era, and they're acting on it, faster than most people realize. The IMF has already acknowledged that tokenized dollars and Bitcoin-backed reserves could extend U.S. dominance into the digital age. In other words, the future dollar may not just be paper, it could be part gold, part crypto. And that's where this affects you directly. If you're still operating entirely inside the old system, you're paying the toll. Every tax, every inflation wave, every transfer fee. The national debt is over $38 trillion and climbing toward $50 trillion by 2033. Interest payments alone now exceed $1 trillion a year, more than defense spending. To manage that, the government inflates the currency, cutting the value of your savings almost in half since 2000. You can either stay in that system or start thinking like the institutions themselves. They're building reserves in gold and Bitcoin before the next reset, not after it. Gold has risen more than 170% since 2020. Bitcoin has outperformed every major asset class, soaring over 1,400% in the same period. Major firms, BlackRock, Fidelity, Franklin Templeton, now hold Bitcoin for their clients. Governments and corporations alike are treating it as digital gold. This isn't the end of money. It's the end of their version of money. A transition from the dollar standard to a multi-asset digital reserve era built on gold, crypto, and tokenized value. Even the Bank for International Settlements, the central bank of central banks, said it clearly: tokenized reserves, gold, and digital bearer assets will coexist in a multi-asset reserve framework by 2030. That's not speculation, that's the roadmap. The only question left is, will you adapt in time? Because history shows that every time gold doubles, the world changes. And this time, Bitcoin may be coming along for the ride. If you found this breakdown helpful, don't forget to like this video and subscribe to Express EconGeoFinance Insights for more deep dives into the forces shaping our financial future. And comment below about the government's plan to reprice gold and buy Bitcoin.